Good afternoon, everyone, and welcome to another one of Avant Garde Trading's free educational trading webinars. And thank you for joining us this afternoon. We are happy to host guest presenter Keith Harwood. He is joining us today to speak with us all about finding trading opportunities for low VIX. Keith, are you with us?
Yes, I should be. Can you hear me okay?
Yes, I can hear you. Thank you for joining us today, taking time out of your schedule. We appreciate
Absolutely.
it. And I know everyone who's here with us live on the Zoom room, thank you as well for taking time out of your days. Keith, if you want, you can go ahead and pull up your presentation. And while you do that, I'll remind everyone live with us today, if you have questions during Keith's presentation, please type those questions into the chat or the Q&A box, and I'll get those over to him at the end of his presentation to address. Keith, I can see your title slide looks great, so feel free to begin when you're ready.
Absolutely. Thank you again for hosting me today, Natalie, and AGT. And yeah, today we're going to talk about finding opportunities for trading with a low VIX. Now, for those of you that have been following the market today, the VIX has actually come back up quite a bit in the last, 8 hours. So Friday, we started to see a pullback in the market, and then that continued today off of some tariff news. But that doesn't mean that there's not a relevance to this opportunity to find a low VIX trading opportunity. Because we may just see another dip buying opportunity for this market and a resumption of that low VIX in the coming days, especially with non-farm payrolls on Friday. So it's good to have that knowledge coming into the week and the way that this market's been behaving. Before we get started, I do have some additional disclosures. All services and content are provided for education and informational purposes only and are not intended as legal or financial advice. So as you may be aware, Option Hotline is not an investment advisor and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. And with that, why don't we get into the actual topic du jour, which is trading with a low VIX environment, which we're chopping in and out of at the moment. Before we get into that, actually, though, a little reminder of who I am for those that are not familiar. I'm Keith Harwood. I started my career, in the option pits of the CBOE. So back in 2005, prior to the subprime financial crisis, I was a market maker on the CBOE in over 100 equity options. And as markets changed, I transitioned to off-floor trading, constructing directional portfolios using options and futures as a market maker, a proprietary trader, and with a hedge fund. So the hedge fund that I worked with was a CTA, a commodity trading advisor. And I worked on all of their option strategies for their directional bias. And CTAs are often very technical trading focused. So I learned a lot about technical trading and how to pair that with options trading knowledge that I had and targeting types of moves and the types of impacts on implied volatility and the option structure to try to generate these high expected value trades given a directional bias. I moved away from that side of things to join the educational side and help retail traders as I was involved with the educational aspect of options trading throughout my career, whether it was as a market maker training new traders or at the hedge fund teaching our portfolio managers and people with decades of trading experience a bit more about the nuance of options, and decided to join Option Hotline back 7 years ago to share my expertise in options, equities, fixed income, and commodity trading, and hopefully pass along some of that information for how I look at markets and how I like to construct directional trading portfolios with options, of course. If you do have to leave early, as many often do, unfortunately, you can always reach out to me. I'm available via email at keith@optionhotline.com. You can call me 312-600-8004 if that's preferred, or send me an email and we can schedule a call if you want to talk further on this topic or anything else related to options, technical trading, etc. And also make sure you're keeping an eye out for email from support@optionhotline.com to receive free giveaways. Sometimes it does get flagged by spam or something. So make sure you're double checking that because, free information is always beneficial to traders when you can digest it and take a look at it after, thinking through some of this stuff more fully. So I definitely urge you to keep an eye out for that email. Free stuff coming your way, and free is good. So we got a lot on the agenda for today. As Natalie mentioned, if you do have questions, throw them in the Q&A box, throw them in the chat box. I will try to address them as I'm going along. And then time permitting, we'll address more at the end of the presentation today in case something pops up. And you've got my email from before. I'll put it up again at the end. If something pops into your mind after the presentation or 2 days from now, you can always feel free to email me. We can chat through some other stuff via email or via phone call. So with regards to today, though, we're going to talk about options in general, why I use options. And because of what the VIX is doing right now, I want to focus a little bit on the option Greeks, specifically Vega. So I'm going to get in a little bit down into the detail on Vega and how it applies to specific option strategies. And in this case, we're going to focus on an outright call trade, but looking at various different ways to implement an outright call trade, because there are many different ways to trade a bull market or a bull market thesis or a bull stock thesis using different options, whether they expire in 1 day, 1 month, 1 year, whether it's at the money, in the money, or out of the money. And how to construct that trade, it can be very difficult for many people, but it also sets up some really great opportunities when the VIX gets to extreme levels, either high or low. It can also mean that I can have the directional view right on a stock, but it still end up losing money by buying the wrong call. So I want to make sure people understand which ways I look at this stuff and the market looks at this stuff to avoid that downfall of buying the wrong option and putting myself in a position for a loss or a minimal gain, even if I've got the directional bias right. All right, so we'll go through Vega, how to swing trade with a focus on Vega, and how to trend trade with a focus on Vega. And within that, looking at some of the signals that I use from a technical basis for a swing trade, and how I look for a trend trading opportunity within the market. And then, of course, the second order Greeks, which are another key element for determining how to look at some of these options and how they're impacted by passages of time or changes in implied volatility and the VIX, and how that can impact the potential risk reward profile of an outright options trade. So a lot to cover today. But I wanted to give a quick rundown before we get into why I use options as a really baseline general concept here. Now, it's always important to keep in mind with options that they do have incremental risks relative to stock. So options often have higher transaction costs than stock. That's the first thing that I always try to remind people, is that fees can matter and often do matter in terms of the risk reward profile. Now, when we're trading an option, we're getting a leveraged contract that generates potential for much bigger returns and also much bigger risk at times. So knowing that, it does impact the way that they're structured in terms of commissions and fees. And those can be an impact when you're dealing particularly with low dollar cost options that are often very tempting for people. But if I'm buying a very cheap option, the fees can actually start to add up. When I'm trading something closer to at the money, it can be less of an impact because the net percentage of the cost of the trade is significantly less. Now, when you deal with short options trade, there is assignment risk. Now, what I'm talking about today, no assignment risk, because we're not going to talk about short options, but it is crucial to understand that when you have a short options position, you can be assigned on the trade, and now that converts into a stock position. Then that's going to have a significantly different capital requirement and a different risk profile from the options trade. So keep that in mind when you're selling options. You do have to keep an eye on that potential for assignment risk. But with our options that we're going long, they decay. These are insurance contracts in their initial implementation. People would buy puts to hedge a long stock portfolio in case of collapse. So ensuring long stock, and that means that because they have a time till they expire, they decay in value every day. An option expiring in 60 days has more value than an option expiring in 30 days because I'm insuring my portfolio for 2 months instead of 1. Having increased time means increased value, but every day that passes that the insurance doesn't kick in, the contract is worth less money. And then, of course, volatility, one of our key elements for today. The value of options is partially dictated by implied volatility, which is the expected future movement of a stock, and it's constantly changing, as we've seen here over the last few trading sessions. So as we see all these little nuances moving around with options, it's crucial to keep that in mind. And those are just touching on some of the key risk factors for options relative to stock, and there's certainly more. But these are some key ones for us, given what we're going to be discussing today. Now, first things first, why do I use options in the first place? So, I've just addressed that there's a lot of different risks and costs associated with options that may make them, a bit scary to some individuals. But at the same time, there is a lot of benefits to options, and they have to be factored into my determination of whether I want to use an option for a trade versus a stock for a trade. And the first thing I always like to look at is, what's the payout of buying stock? So it may seem simple, but if I'm trading, I'm always setting a stop loss and a price target. So let's come up with a hypothetical example here. I'm buying a stock for $100 a share because I think it's going to $120 a share. I'm thinking I'm going to get a 20% appreciation in this stock. But if it goes down to $90, I need to stop out of my position and take a 10% loss. So there's a positive expected value here if I think there's an equal chance that it goes to $120 or 90. But of course, this isn't binary. Stocks can go to 110, it could go to 95. So every dollar of appreciation in the stock is a dollar of appreciation in or 1% appreciation of my investment. If I'm investing $10,000 into a $100 stock, I can buy 100 shares. And if it goes down to 90, I lose $1,000. If that's my risk tolerance, my projected reward is $2,000, twice my projected loss in the bad case. However, there is a scenario out there where the stock can gap down. We've seen it off of earnings, off of other fundamental inputs, where its stock goes well below the stop loss and takes a much larger per share loss than expected. I could wake up tomorrow morning and find that my $100 stock is trading $60 because of fundamental news. Now, instead of losing $1,000, I'm losing $4,000, and I still have to exit. I don't want to hold on to that just because it lost more than I wanted. In fact, I'd much rather hold on to something because it made more than I wanted than when I lose more than I wanted. So I don't have fully defined risk other than the amount of money that I've invested into this stock position. On the other hand, with a call, I get the right but not the obligation to buy the stock for a specific price on or before the expiration date. So if I have a hypothetical $100 strike call, that gives me the right but not the obligation to buy the stock for $100 anytime before expiration. In this case, I'm saying 1 month. So over the next 30 days, I can buy the stock for $100 a share. And because I have that option but not the obligation, I have to pay a premium. In this case, my sample payout or my sample chart is for an option that has a premium of $5 per contract. Now, if I buy one call option, it gives me the right to buy 100 shares, and thus the total cost is $500. If I want to risk a total of $1,000, I can buy 2 call options now. Then my total investment is $1,000, and I have the right but not the obligation to buy up to 200 shares of stock. And if the stock is trading $105, I'd much rather buy it for 100 than go to market and pay $105. And if the stock is trading 90, I'd much rather buy the stock for $90 or not buy it at all, but I certainly am not buying it for $100 a share. Now, with that call, because I have the control, because I'm the owner, I don't have to exercise this. So if the stock goes down, I just lose my premium. That's my $1,000. Whether it goes to 99, 90, or $3 a share, the max I can lose is $1,000. On the upside, if it goes to $120 per share, this call option is now worth $20 because it's in the money by $20. I can exercise it, buy the stock for 100 and sell it for 20. But I've paid $5. So my net profit is $15 per contract or $3,000 on 2 contracts. It's a trade-off. Call options give me the leverage to the upside, the defined risk to the downside, and I'm making less money in between. So if the stock only goes to $105 a share, my profit in terms of stock movement is offset by my initial premium. If it goes to $120 a share, I'm making a leveraged return relative to a stock investment. And if it goes below $90 on a gap down, I'm still capped out at $1,000 of risk. So above $110 and below $90, I'm better off in options. Anywhere in between, I'm actually better off just holding the stock and having that opportunity to appreciate with the stock movement or take a smaller loss in case of a slight bearish movement. And that's the key to options trading is I'm looking for leverage and I'm looking for movement. If I'm buying an option, I need movement. And we haven't seen that much movement in the market right now. So that may scare some people away, but there are opportunities out there if I can identify the trade before it starts to move, especially when options get cheaper and cheaper. All right. And that's where that implied volatility kicks in. That makes the options cheaper when it goes down and more expensive when it goes up. When we're valuing an option, the most well-known option pricing is Black-Scholes. Generally, it's got the same 5 inputs for any options model. The key ones here are the underlying price, which is given by the market, $100 a share in my sample stock. Strike price, which is given by the market but selected by the trader. In my case, the $100 call. I could have gone out and bought the $120 call or the $90 call. But in this scenario, that's selected by me, and it's given once it's selected, that is the strike. I can't change the terms of the contract. The time to expiration, that is given by the market. Once I've selected my strike, that doesn't change other than the passage of time every day. And then there's the risk-free interest rate, which is generally given by the market and has some fluctuations right now. The 10-year yield, for example, is about 4.25%. It shifts up and down a little bit here and there. When we're dealing with shorter term options, it has less impact, but when you deal with long-term options, that can have a significant impact on the option value. And then finally, implied volatility. This is constantly changing and is estimated by the trader. So when I'm looking at a stock that's not moving, I have to understand whether I expect it to start moving or continue to not move. If I expect it to continue to not move, then that's that scenario in the trade-off where I don't want to buy the call option. I want to buy it when I expect it to start moving more than the market is expecting right now. So as I mentioned, the value of options is dictated by this implied volatility, the expected future movement. The VIX is an index that tells us what the current market is expecting for future S&P 500 movement. It's often referred to as the fear index because it goes up when the markets are panicking. We saw that this morning. The market was down 1.5%, and the VIX rose over 19%. Settled in around 17 and change. Last week, it was in the 14s. Realized volatility is what we've seen occur recently, and implied volatility is what we expect in the future. Now, you got to keep that in mind because realized volatility does not guarantee future volatility. Sometimes a stock moves drastically due to a fundamental input like earnings. After that input, the market is in digestion mode and it doesn't have to move at nearly the same rate. And lack of movement doesn't always mean lack of future movement. Oftentimes we do what's called consolidation, where a stock trades in a range, and then once it breaks out, it can start to move a lot more meaningfully and a lot more volatile. All right. So just because we haven't been moving doesn't mean we will continue to not move. And just because we have been moving doesn't mean we will continue to move. So we've got to have a way to identify stocks that may stop doing what they've been doing recently. Stop not moving or stop moving. And that's the key of swing trading, is finding, for me, stocks that have not been moving, but have reached a point from a technical level that they may start moving. The main option Greeks that we always consider when going through all of this stuff are as follows, okay? Delta is the change in the option value relative to the change in the underlying price. That's the most natural one for most people to understand. If I'm buying an at-the-money option, it's about a 50 delta. So every dollar of appreciation in the stock should give me about a 50%, 50 cent appreciation in the option. Passage of time is how much that option decays every day that doesn't move. That's theta. The interest rate is rho. Again, not hugely impactful for what we're dealing with today, but certainly to be aware of. That's the change in the option value relative to a change in interest rate. And then vega. That's the change in the option value relative to a change in implied volatility. So when implied volatility goes from 14% to 18%, when the VIX rises 4%, how much does my option change in value? And it's linear in some cases, and it's not so linear in others, and we'll come back to that. We're also going to touch today on the second order Greek's VAMA, which is the change in vega relative to a change in implied volatility. So you can start to see how parabolic shifts can occur within options when vega is really moving a lot, when implied volatility is moving a lot, and that passage of time, so that I know how quickly I need implied volatility to change to generate a significant return based upon a vega portion of my trade. So first things first, let's look at the Vega. When I'm dealing with buying an option that is low implied volatility, I have to understand how much that option can change in value if implied volatility changes from current levels. So in a scenario of implied volatility around, say, 20%, when I have implied volatility rise from 20 to 24%, a 4% shift on a option expiring in about a month and a half, it would raise in value from about $3 to $3.50. So a nice 15 to 20% appreciation in value. On a long-term option, a very similar impact, going from $5 per contract up towards about $6, about a 20% increase in value. So I could certainly see a 20% increase in value just off of implied volatility rising from almost any term here if I'm dealing with at-the-money options. When I'm dealing with further out-of-the-money options, implied volatility levels matter that much more, especially as I get into longer and longer times. So if I only have a data expiration, a rise in implied volatility from 20 to 24% has no impact on my option. It's still worthless. On an option expiring in about a month, it can raise from maybe a couple of pennies up towards a dime. This is why I don't sell 1 or 2 cent options almost ever. I mean, there's almost no reason to sell those options unless I'm just trying to take off a long position to get it off my sheets. Because selling a 2 cent option and seeing implied volatility rise, I can lose 5x my initial premium collected. When I'm going for longer and longer times, this can be much quicker and much more painful if I'm selling out of the money options with implied volatility near lows. If I sell implied volatility by selling a $120 call at 20% that expires in 3.5 months, the value can increase from, call it 50 cents to $1 on that small 4% increase in implied volatility. So now that option can double in value on the same implied volatility shift that was only giving a 20% change in the option value when at the money. So out of the money options can be a very useful tool when buying cheap implied volatility and seeing it rise, and it can be a very dangerous tool when buying high implied volatility and seeing it fall, or when selling low implied volatility and seeing it rise. For that reason, I tend to tell people, particularly at the beginning of their trading journey, to focus on these at-the-money options. When I deal with an out-of-the-money option, there's a lot more risk associated with them in a percentage term. Maybe not in an absolute dollar term, because it's an option that shifts in value from 50 cents to $1, 50 cents. But that's 100% change in the value. So the out-of-the-money options have a lot more Vega risk to them, while the at-the-money options have a lot more risk associated with delta and theta, and simply the general movement of the stock away from the strike. Vega means the change in the option value relative to the change in implied volatility. And again, implied volatility is that expected future movement in the stock, and it's priced in percentage terms. For a simple calculation of what the market is pricing in, you can take the current implied volatility and divide it by 16, and that is the expected daily move. So when the VIX is 16%, that means that the market is projecting a 1% daily move in the market. The 16 VIX sounds generally pretty low given what we've seen historically, but when you start putting it into terms of how much we have to move per day for the market, it starts to look kind of high when it's 16%, because we don't normally see a lot of 1% moves in the market. And that's part of the problem with the VIX. When people look at a low VIX and say 14%, wow, that's historically low, it's often happening when the realized volatility of the market is moving 0.5% or less. So buying a bunch of 14 VIX options, I can get eroded by decay, option decay, and everything else. So even though implied volatility may rise, the theta of my position may be a bigger impact on me than I'm realizing, because we're not often moving 1% per day when the VIX is at 14. And when we do see a 1% move like we saw today, the VIX goes back up to 18, 19%. And it's more in line, but not drastically overpriced relative to today's movement. So how do I find a technical setup that can illustrate the potential from a breakout from consolidation, or let me get into a trade at the early part of the move and really leverage these options when the VIX is low? Whether a new trend is forming or trend is continuing, The first step is to stop consolidating and start moving. Okay. Now, with all that in mind, when the market is consolidating, it often leads to a lower VIX and cheaper options. So while we're seeing that 0.5% range every day or less, the VIX continues to drift lower and lower, maybe not all the way down to only implying a 0.5% move per day, but certainly not projecting out 1.5%, 2% moves. And since the options are getting cheaper, I get more leverage if and when we start that move. So I'm looking for those opportunities when the market's not moving that could be setting up a move coming in the near future. And the move that I'm generally looking for is a move outside of the range. It's called a rectangle. So we have a horizontal resistance and a support line that supports the breakout or breakdown in the market. If we go to a new high, it's a breakout. What we saw last week on Thursday was a breakout. It was then rejected. We didn't see the movement continue up further to the upside. We saw a breakout and then a failure back down to the lower part of the range. When I see a breakout, I like to see some continuation and then support at the previous high start to form and then a follow through. Unfortunately, not what we got. But it happens very frequently when we've been going through these long periods of consolidation that we test the highs and then don't get the follow through. And then ultimately at some point, the market stops trying to go to new highs and actually does. And when that happens and I get a follow through to the move, I can start to get big returns just from being long that at the money option, as I mentioned in the first example. When I don't get the follow through, I take a little bit of a loss and I have to move on and wait for the next trade, wait for the next opportunity. The S&P 500 is trading in a range. We've continued to chop higher and higher, but very limitedly so. So we go through a rectangle, try to break, and then bounce back into the range. Try to break out, and then bounce back down into the range. Try to break out, and then bounce back down into the range. Over the last 3 months, we have been consolidating drastically. Now, of course, when we go back out 6 months, we factor in everything that was going on in April with tariffs, and that's not the case for what we've got right now. That VIX was much, much higher. The realized volatility was much, much higher. We saw a 10% range in one day, much less over the course of a year. Now we're trading in very tight ranges, even with the drop that we saw this morning. And so I'm waiting and looking for the S&P 500 to provide a tailwind to the general market and a lot of the stocks that I'm looking at. And if and when it does break out to a new high and starts to follow through instead of retracing back after attempting the move, that's where I get my setup for a long call option in a trade when the VIX should be back at lows. And once it happens, we get that breakout type move with a parabolic type payoff for a short-term swing trade. We either have a rising channel, which we have a very slight rising channel right now, or we have a sideways channel. Once that move is done, like we see at the beginning of this chart, we often go into a trend channel for a longer term. So we often get a breakout and then a new trend. The initial move can be capitalized on, but don't worry, if you miss the initial move, it can often set up a trend channel for the long term. And that creates an opportunity in a completely different option structure. So rather than buying a short-term call option for a quick move, now I start looking at how do I capitalize on the trend over the long haul. And if implied volatility is in line with the trend, where it's generally appreciating by about, say, 0.1% per day, then I can capitalize on that. If the trend is going up 1% per day, it gives me a different input for how I want to leverage this trade. Because if I'm chopping within a range and going up 1% per day, I really only need the implied volatility to illustrate a potential for a move of about 0.5% per day. Half of the implied volatility or half of the trend channel would give me a great leverage return for that directional move. And I can start to estimate the expected monthly return of the stock using the slope of the trend lines. So if I have a trend line, I can draw two lines and say at the midpoint of those two trend lines 1 month from today, where will the stock be trading if it holds? That gives me a great tool for projecting a price target 1 month from now. And then I can look and see which which option gives me the best return in that scenario. So to walk through an example here, if we have a $100 stock and it's appreciating at a rate of 10% per month, based upon the trend channel, then I need to see which option is going to give me the best return in case we rally that full 10% over the course of a month. In the case of the options that I was talking about at the beginning, the $100 call would go from $5 up to 10 over the course of a month if the trend channel holds. That's 100% return, significantly better than the 10% return of buying a stock. If the options are pricing implied volatility high relative to the expected return, it's not giving me the leverage I need to structure my options trade any differently than if the options are pricing in, then it is not giving me leverage and I need to structure my options trade differently than if the options are pricing in implied volatility low relative to the expected return. So let's say in my last example, instead of looking at a stock that's appreciating or expected to continue appreciating at a rate of 10% per month, it's only 2% per month, much like the current S&P 500, where we get very, very slow grind higher. Buying an at-the-money option for a 2% return doesn't give me any leverage. In fact, it gives me a loss because I have to get to $105 a share just to break even. That's not a good trade for a trend in options. So I don't want to go out there and just naturally always buy calls just because there's a trend. I have to determine if the trend is strong enough to offset the implied volatility of the market and the premium that I have to pay. Now, I use a triple moving average signal to find my technical trading entries for a trend. I don't have enough time today to do a full trend trading conversation. So I'm going to send you my 5 indicators for trading success ebook separately, and that goes through the triple moving average and the other signals that I use for stocks once they're within a trend. And again, keep an eye out for support at optionhotline.com to receive that free ebook and walk through that one. If you have questions, email me, keith@optionhotline.com, or you can also email support@optionhotline.com, and I can help walk through a little bit more with you so that you understand how those trends not only begin, but also continue and what signals the end of a trend. So, I've kind of gone a little bit over the concept of what I want to look for when I'm buying an option for a swing, with a short-term option trying to generate a quick return and then an exit, or a trend comparing the premium I'm paying for the option relative to the price target that I've got set because of a trend. But the other thing that I have to factor in is how much can this value of this option get impacted by Greeks like Vega and second order Greeks. So once the implied volatility starts to move, how much more can it cause me either pain or reward? Now, to visualize Volga, which is the change in Vega based upon the change or dependent upon the change in implied volatility, I can simply look at whether it's a linear chart or a parabolic chart. That changing slope is Volga. That parabolic shift. I have a lot more second order Greek exposure in an out of the money option than an at the money option, which means now that out of the money option has a lot more risk embedded within it. Not only am I subject to changes in implied volatility at a greater rate, I'm actually subject to greater changes in Vega every time that implied volatility changes. This is one of the reasons that, frankly, even though implied volatility is low, I want to focus on these at-the-money options for a trend. I don't want to expose myself to excess Vega risk, and I don't want to expose myself to Volga risk on top of that. Otherwise, I could have a situation where I have a parabolic upshift, not normally the case in a bull market, a parabolic downshift in the value of my options simply off of the change in implied volatility. With regards to Vega, which is the change in Vega based upon the change in time, as time passes, implied volatility shifts mean that, as time passes, Vega decreases. The slope becomes flatter and flatter, especially on these out of the money options. So if my move doesn't happen quickly, even if eventually the implied volatility rises, it has a less beneficial impact for me over time. Again, makes for those out of the money options to be very difficult to manage with a long holding time frame. So do I want to expose myself to excess risk with an out of the money option, or do I want to focus on something much more linear when I'm dealing with a trend trading opportunity? I think I'd rather be linear and take my risk and keep it a little bit more predictable. And you can see that shorter term options have a flatter slope than longer term options. And this is because the less time that there is for an option till expiration, the smaller the impact of changes in implied volatility on the value. So even still, when I'm going into a trend, if I buy long-term options, I'm going to have more Vega risk. I don't need to expose myself to these extra risks like Vega and Volga by going with out-of-the-money options. On top of that, VAMA and Volga has a self-fulfilling prophecy effect. As implied volatility rises, people tend to reduce position sizing, which means that implied volatility moves more. That creates greater movement when people are reducing position sizing. It's that risk-off behavior, and more move in higher and higher implied volatility. So that parabolic shift can get really put into place that much more impactfully, particularly when the market is falling. When implied volatility falls and the market's grinding higher, position sizing tends to increase, and that creates greater liquidity in the underlying asset and helps reduce implied volatility even further. So again, if implied volatility is starting near a higher point, as it comes down, it tends to come down more. Again, adding more and more risk to those out-of-the-money options. Now, the VIX on Thursday was at lows at 14. Today, it got above 19%. As that implied volatility starts to fall back down, that would be expected in the case of a market rally. Out-of-the-money call options, which may seem attractive because we're now at the lower part of the range instead of the upper part of the range, are actually much riskier because we have this Vega impact. So out-of-the-money options, they'll look cheap. They can get cheaper even if the market tests a new high and starts to break out. So I don't want to be, again, in out-of-the-money options. I think there's a theme you may be noticing here. Buying out-of-the-money call options when the VIX is starting to now come back to highs is dangerous. But it doesn't mean it's great when the implied volatility is at lows, unless I can predict that that trend is really meaningfully greater than the implied volatility of the option is projecting. When we zoom in here over the last 3 months, you can see how low the VIX has been getting. It keeps testing around 14%, and the high point we've been getting is around 20. And we got close to that level today. So that implied volatility did shift up significantly, but in such a way that it really makes for those out-of-the-money options that much more dangerous in the current environment. When the implied volatility is low, it doesn't necessarily mean that I want to buy out-of-the-money calls. It just means that there's less risk associated with them in terms of Vega, Volga, and Veda. And it's particularly true because of the VIX term structure. When implied volatility is low, longer and longer timed expiration tends to be higher. But as time passes, implied volatility falls towards that lower level, So on an option expiring in 3 months, that's 20% implied volatility, it has a natural drift down towards 19, 18, 17, 16, all the way down to 14. So the more that time passes, the more implied volatility tends to fall. So again, those second order Greeks really kick in and take away that parabolic return potential for the longer term option. They're priced higher, and they tend to not have that great ability to go parabolic in a bull trend. Where these go parabolic is when we're going bearish, and that's not the current market condition. So again, I'm not necessarily saying that I would go out and sell a bunch of far out of the money options. I would just avoid them. Not because they're going to potentially pay off significantly worse, but because they're not always going to pay off with nearly the same probability and predictability as a near at the money or an in the money option. And that's what I tend to do with a trend, is I go with an at the money or in the money option in order to avoid that risk of the term structure, the Veda, the Volga, all of these other elements that add a lot of potential confusion and random behavior to the options market. So if I'm going to go out for 3 to 5 months to expiration with an in the money 60 to 80 delta call in a $100 stock, that might be a $90 or a $95 strike. This gives me a good balance of the delta, the predictability from calculating my trend, and avoiding some of those risks associated with Vega, even though the VIX is low. And that's the general gist of it with a trend and a stock replacement strategy, is to avoid adding incremental risk while continuing to use what is my friend, which is the trend, and what is more predictable, which is the delta and the directional move of the stock. So that's the main idea here, again, if you have questions, you can always contact me, Keith at optionhotline.com, or call me 312-600-8004. Keep an eye out for support at optionhotline.com to receive the free giveaways. And I saw a couple of questions that came in that I did not address and some that I did. So I will try to do my best to get through some of those right now. First one I see, would I trade the VIX? There are a lot of VIX trading strategies out there. Some of them using options and some of them just using the VIX future. Now, the VIX option strategies tend to be built upon trading for that decay when the term structure is the way that it is or was on Friday and Thursday, where longer dated options have a natural decay down to the current front level of 14%. So the idea here is if I want to project that the market's going to continue to consolidate or grind higher, I would be bearish the VIX future expiring here in mid to late October, because I would expect it to drift down towards 17, 16, 15, 14, or maybe lower. By defining my risk by buying an at the money or in the money put expiring on that time, I can still get some price appreciation. But much like buying an out of the money call in the S&P 500, I have a lot of risk if I go out and buy a 14 strike put here, because we may not get all the way down to a new low in the VIX. So I'm buying premium in a strike that's unlikely to finish in the money. And the VIX tends to have a different option structure and a lot of nuance to it. And I could do a whole talk on VIX options, but probably not going to fit in on time today. So I will save you from that for now, but maybe it'll be a topic in the future. But actually trading the VIX futures, the biggest danger is that the VIX has a tendency to spike or grind lower. So it either spikes up like we saw back in April, March, or it grinds lower over the long haul. So using the VIX as a hedge as opposed to buying an out of the money put is a valid approach for many people. Or for me, generally, most of the time, I'm using the VIX as an indicator of where I may find opportunity within the market as opposed to trading it outright. Are there any other questions that people have for today? Oops, go back and leave my contact information up.
Yeah, perfect. Thanks. Yeah, the other questions we got were basically about were we going to send out the recording? Where can people, watch this presentation again? Because there's so much good information here. And I let everyone know, I'll reiterate it here. We are going to send out the recording tomorrow, so everyone can check their email inboxes for a link to the recorded replay of today's webinar. That's going to come from info@tradeagt.com. And if there, as Keith mentioned, I'm going to take quick screen share back, okay? If there are any other questions that pop up in your mind tonight, later this afternoon, tomorrow, next week, you can reach out to Keith directly. He put his contact info up there for you all. And if you have general questions for Avant Garde or about our webinars, you can send those over to info@tradeagt. But as Keith pointed out, we are pushing up against our time frame here. It did sound like, Keith, you might have an idea for our next presentation there, focusing on the VIX a little more in depth, a little more deep dive.
Absolutely.
So maybe that's one coming up for us.
Yeah, no, it's a good idea.
Yeah. So thank you for that good question. And keep the questions coming, you all, not only during the live webinars, but like we said, send us emails. You can send to Keith directly, you can send Avant Garde emails, and keep the good questions. We're always interested. We want to know what you all want to learn about. So tell us. Oh, we have one more question about other webinars. Yes, great question. The question is, do you grant access to older webinars? Yes, we do. If you all can see my screen right now, I'm on our website, avantgardetrading.com, on the education page. If you just scroll down to the bottom of the education page, you can click off this search area, check off everything here, and it'll show you all of the archived webinars that we have started since we launched our BD. So you can go ahead and click any of these and watch them directly on our website, on our YouTube channel, at any time that you want. And like I said, we'll be sending the email out tomorrow to everyone with a recorded replay. Keith will definitely have you back As we do, thank you again for taking the time to put together that presentation and teach us all and answer the questions thoughtfully. We do appreciate that. And thank you to everyone who signed up today. Those of you who attended live and asked some good questions, thank you for engaging. And we look forward to seeing you all. Join us Thursday. We have another webinar coming up. So sign up, subscribe, and we can't wait to learn some more options trading with you all. Thanks again, and good trading to everybody.